Maya had $2,000 in her trading account. She opened a position that controlled $10,000 of currency. The trade moved against her, and the number she thought was her account value suddenly was not the number her broker used. She had not lost the entire account, but she had lost the ability to trade safely. The missing idea was margin mechanics. In this video, we will follow Maya through one position and answer the questions that matter in real time. What money is actually hers? What money is reserved? And how much room remains before the broker takes control? The surprising part is that a profitable-looking balance can coexist with a dangerous equity figure. So we begin with the number that does not move when an open trade moves. Maya's account balance is the cash value recorded after deposits, withdrawals, and closed trades. It does not automatically change just because an open position is currently winning or losing. That open result is unrealized profit or loss, also called floating profit or loss. If Maya closes a trade for a gain of $100, that gain becomes realized and her balance rises. If the trade is still open and showing $100 of profit, her balance may still display the original $2,000. Equity gives us the more honest live snapshot. Balance plus unrealized profit or loss. So if the open trade is down $180, equity is $1,820 before other charges. A closed loss lowers balance. An open loss lowers equity first. That distinction matters because brokers usually judge available trading capacity from equity, not from the comforting balance figure. But equity alone still does not tell us how much money is free. Required margin is the amount reserved when Maya opens a position. It is not a fee, and it is not the maximum she should risk. It is collateral. The broker calculates it from the position's notional value and its margin requirement. In our example, $10,000 of exposure with a 5% requirement reserves $500. That is equivalent to 20-to-1 leverage. The $500 becomes used margin. If Maya opens a second position requiring $300, total used margin becomes $800. Free margin is equity minus used margin. With equity at $1,820, Maya has $1,020 of free margin. That is the part not currently reserved and potentially available for another trade or for absorbing a floating loss. The trap is assuming that free margin is permission to keep adding positions. It is only remaining capacity. The broker's next calculation tells us how quickly that capacity is shrinking. Here is where leverage creates confusion. Maya contributes $500 of margin to control $10,000 of exposure. That does not mean she can safely lose $500. Her actual trading risk depends on the entry, the stop, the position size, and the distance to that stop. A small market move against a leveraged position can create a meaningful floating loss. This is the money beat. The broker has reserved $500, but the entire $10,000 position is still moving against Maya. Required margin answers how much collateral one position needs. Used margin answers how much collateral all open positions need. Free margin answers how much equity is not reserved. None of these answers tells us whether the trade idea is good. That requires a risk plan. And before the broker restricts anything, we need one percentage that combines the live equity with the reserved margin. Think of leverage as a ratio between the position's notional value and the margin reserved for it. Higher leverage lets a smaller deposit control a larger position, but it does not reduce the dollar loss created by an adverse price move. A trader can use modest leverage and still risk too much if the position is oversized. A trader can use higher leverage and risk a controlled amount if the position is small and the stop is defined. The broker is measuring collateral. You are responsible for measuring loss. That difference is why a margin calculation should sit beside a position size calculation, not replace it. Maya now has one open position, equity of $1,820, and used margin of $500. The next number turns those facts into a warning light. But how would you read it before I show you? Pause and answer this before I reveal it. If equity is $1,820 and used margin is $500, what is the margin level? The calculation is equity divided by used margin multiplied by 100. That gives 364%. This is the thing this whole video was building to. Margin level shows the cushion between live account value and reserved collateral. If the position loses more, equity falls. If used margin stays the same, the percentage falls. Notice that the balance can still display $2,000, while the margin level deteriorates. Brokers set their own thresholds. One broker may restrict new positions below a certain percentage, another may use a different limit, and some products receive different requirements. A broker may also increase requirements around specific conditions, so never memorize a universal number. Find the exact margin call and stop out rules in your broker's documentation. The useful thing still coming is how this behaves on the live euro/dollar chart. A real live euro/dollar candlestick chart appears here. Do not begin by searching for a perfect shape. Start by checking the account side, balance, equity, used margin, free margin, and margin level. Then scan the chart from left to right. Mark the recent range, identify whether the spread is reasonable, and wait for a candle close beyond the range rather than reacting to a temporary spike. The rectangle you are watching has this classification: complexity, simple, direction, neutral before the break, type, continuation when the breakout resumes the prior trend, context over pattern. Where the shape appears on the chart matters more than the shape itself. For a bullish breakout idea, the entry trigger is a candle close above the range, followed by acceptance above it. Place the stop below the range, with wiggle room beyond the nearest swing rather than directly on an obvious edge. Set a target at least 2 times the distance from entry to stop, or skip the trade if the chart cannot offer that space. Patterns fail. The stop is what saves you. Before placing anything, calculate the margin and the cash risk together. If Maya keeps the position and the floating loss grows, equity falls and margin level falls with it. At a broker-defined threshold, new trades may be blocked. At another threshold, the broker may issue a margin call, send a warning, or require more funds. If the account reaches the stop-out level, the broker can forcibly close positions, often beginning with the position that has the greatest effect on margin. The exact sequence, percentages, and terminology vary, so the broker's rules are part of your trading plan. Do not rely on a notification arriving in time. Markets can move quickly, spreads can widen, and closing may occur at the next available price. Maya's protective response is not to wait for a margin call. She sizes the position so the planned stop risks a small, predefined portion of equity. Her entry trigger is the confirmed breakout, her stop sits beyond the structure with room for normal noise, and her target is 2R or better. If the breakout fails, the stop closes the trade. If the required margin looks uncomfortable before entry, the position is too large. Let's leave Maya with 5 rules. Balance records closed trade cash. Equity includes the floating result of open positions. Used margin is collateral already reserved. Free margin is equity minus used margin. Margin level is equity divided by used margin multiplied by 100. Amateurs count pips. Professionals count risk and margin together. Return to the opening situation. Maya did not need a bigger account or a more exciting entry. She needed to know that her balance was not the same as her equity, and that her free margin could disappear while the trade remained open. She could then reduce size, place a real protective stop, and avoid handing the decision to the broker. Which pair are you practicing this on? Name it in the comments. Next time, we will use the same disciplined process to connect position size, stop distance, and the exact dollar amount at risk.